In December 1973, the governor of the Bank of England called the chairmen of the major clearing banks to a meeting and told them that the British banking system was days away from collapsing. Not a bank, the system. The institutions in trouble were not the ones anyone was watching. They were not Barclays or Midland or Lloyds. They were companies with names most people had never heard. London and County Securities, Cedar Holdings, Triumph Investment Trust. And the reason nobody was watching them is the whole point of this story. They were not banks. Legally, technically, formally, they were not banks at all. They took money from the public and lent it out at interest, which is what a bank does, but they had been incorporated under a different section of a different act, and so they fell outside the Bank of England's supervision entirely. Nobody had decided that. It was not a policy. It was a gap, and it had been sitting there for years while a whole parallel banking system grew inside it. This is the story of the secondary banking crisis, the largest British financial rescue between the war and 2008, run almost entirely in secret, and now so thoroughly forgotten that most people working in the city today have never heard of it. Start with what a secondary bank actually was, because the category is unfamiliar now. In the 1960s, British banking was dominated by a small number of clearing banks, the ones with branches on every high street. They were conservative, cartelized, and heavily constrained. The Bank of England did not supervise them through formal rules so much as through what was known as the governor's eyebrows, informal pressure, private conversations, and an understanding of what was and was not done. That system worked after a fashion because the number of institutions was small and they all knew each other. Alongside them, a second tier had grown up. These were finance houses, hire purchase companies, property lenders, and investment trusts. Some had been operating for decades in specialist niches. Others were new. What they had in common was that they took deposits from companies, from local authorities, from wealthy individuals, and increasingly from the wholesale money markets, and lent that money out, which is banking. But they held their banking status, if any, under Section 12(3) of the Companies Act 1967, a provision that allowed the Board of Trade to certify a company as carrying on a banking business for certain purposes. It was a technical designation obtained largely for tax and commercial reasons. It did not bring them within the Bank of England's supervisory arrangements. The bank supervised institutions on the list it maintained under the Exchange Control Act, the authorized banks, and the secondary institutions were not on it. So you had a growing number of companies performing the economic function of banks, describing themselves as banks, being treated by the public as banks, and being supervised by nobody. Now the fuel, because the gap alone would not have produced a crisis. Two things happened at the start of the 1970s that turned a structural weakness into a disaster. The first was competition and credit control, introduced by the Bank of England in 1971. It was a genuine and largely well-intentioned reform. The old system of direct lending ceilings and the clearing bank interest rate cartel had become distorting. It restricted competition and it pushed lending outside the regulated sector precisely because the regulated sector was capped. So the bank dismantled it. Lending ceilings went, the cartel went. Banks were to compete freely, with monetary policy operating through interest rates and reserve requirements rather than direct instruction. The intention was to bring lending back into the visible, supervised system. The immediate effect was an explosion of credit. bank lending to the private sector rose enormously in the following 2 years, by some measures more than doubling. Money supply growth ran at rates that would now be considered alarming. The second thing was the property boom, and the two are inseparable. Commercial property prices in Britain rose extraordinarily in the early 1970s. Office values in London roughly tripled over a few years. Development sites changed hands repeatedly at rising prices, and each transaction validated the next. For a lender, property is attractive collateral. It is tangible, it is valued by professionals, and in a rising market, the loan-to-value ratio improves every month without anybody doing anything. The secondary banks lent into that boom very heavily indeed. It was their principal business, and their principal appeal to depositors was the interest rate they could pay, which they could afford precisely because property lending was so profitable while values rose. Now the structural problem inside those institutions, which is the mechanism that actually killed them. A property development loan is long. A building takes years to design, obtain permission for, construct, and let. The lender's money is committed for the duration. The money funding those loans was short. Secondary banks raised much of their funding on the wholesale money markets, deposits placed for weeks or months by companies, local authorities, and other financial institutions seeking a return on cash. So the balance sheet was fundamentally mismatched: long, illiquid assets funded by short, mobile liabilities. That is the same structure as an ordinary bank, which also borrows short and lends long. The difference is that an ordinary bank has a branch network of retail depositors who are sticky, holds reserves, and crucially, has access to the central bank as lender of last resort. The secondary banks had none of those things. Their depositors were professional, unsentimental, and could move money elsewhere with a phone call. They held minimal reserves. And because they were not on the Bank of England's list, they had no lender of last resort at all. That combination is only stable while confidence holds. The moment the wholesale market declines to roll over a deposit, there is no mechanism for survival. Then 1973 happened. Then tilling. Interest rates rose sharply as the bank tried to control the credit expansion it had unleashed. Minimum lending rate reached 13% in November, an extraordinary level at the time. Rising rates do two things to a property lender simultaneously, and both are fatal. They increase the cost of the short-term funding immediately because those deposits reprice every few weeks. And they reduce the value of the property because a building is worth the income it produces discounted at prevailing rates, so when rates rise, values fall. Costs up, collateral down at the same moment. Then in October, the Yom Kippur War produced the oil embargo. Oil prices quadrupled, and Britain entered a period of severe economic disruption. In December, the government imposed the 3-day week to conserve electricity during the miners' dispute. Into that environment, on the 20th of November 1973, London and County Securities, a secondary bank with a high profile and political connections, announced results that revealed serious problems, and its share price collapsed. The wholesale market did what wholesale markets do. It stopped lending to anything that looked like London and County. That is the moment the crisis began, and it moved with remarkable speed. Deposits were withdrawn from secondary banks across the sector, not because each institution had been individually assessed and found wanting, but because nobody could tell which ones were sound and the cost of finding out exceeded the cost of simply withdrawing. That is a run. It has the same logic as a queue outside a branch, conducted between institutions by telephone, invisible to the public. Within weeks, a substantial part of the secondary banking sector was insolvent or heading there. Now the response, which is the genuinely interesting part. The Bank of England had a problem with no good options. It could let them fail. That was the technically correct answer. These institutions were not authorized banks. They had taken risks knowingly, and there was a strong argument that rescuing them would reward recklessness and create an expectation of rescue for the future. But the bank rapidly concluded that letting them fail would not stay contained. The reasons are worth setting out because they are the standard argument for intervention, and this is one of the clearest cases of it. First, the secondary banks owed money to the clearing banks. The clearers had lent to them, taken their paper, and in some cases owned stakes in them. A cascade of secondary failures would land on the primary system. Second, the depositors were not only professionals. Members of the public had money with these institutions, believing them to be banks because they were called banks. Third, and most importantly, a wave of forced liquidations would have dumped an enormous quantity of commercial property onto a falling market simultaneously. That would have driven values down further, which would have impaired the property loans held by the clearing banks as well, turning a secondary crisis into a primary one through the collateral channel. So on the 19th of December 1973, the governor, Gordon Richardson, convened the clearing banks at the Bank of England and put a proposal to them. The clearers, together with the Bank of England, would provide recycled deposits to the secondary banks, replacing the wholesale funding that had disappeared, to allow them to remain liquid while their property assets were sold in an orderly way over time rather than dumped at once. This became known as the lifeboat. The details matter. The bank contributed around 10% of the support and the clearing banks. The remaining 90%, which was a deliberate design, the bank did not want to be seen to be underwriting institutions it had never supervised, and it wanted the clearers to have their own money at risk so that they would insist on discipline. At its peak, the lifeboat had extended something over £1 billion of support. An enormous figure for 1974, comparable in relative terms to interventions that would later be discussed in trillions. More than 20 institutions were supported. Some were wound down, some were sold, a few survived in altered form. And it was done, as far as possible, quietly. That is the aspect of this episode that is most striking now and most alien. There was no announcement, no press conference, no statement to Parliament at the time, no televised address. The rescue was arranged in private meetings between the governor and the clearing bank chairman, and the participants agreed not to discuss it. The reasoning was straightforward and, in its own terms, sound. The entire problem was a loss of confidence, and publicizing a rescue would confirm the thing depositors were frightened of. Secrecy was not a cover-up in the sense of hiding wrongdoing. It was regarded as the operative mechanism of the rescue itself. Whether that could be done today is doubtful, and it is worth asking why. It required a small number of institutions, a governor with enough authority to summon them, a press with less capacity to investigate financial arrangements, and a culture in which a private undertaking between gentlemen was regarded as binding. Every one of those conditions has weakened. The 2007 run on Northern Rock, Queues in the Street, filmed, is what happens when the same problem occurs in a world where it cannot be kept quiet. Now the cost and the outcome, because it is often described as a success, and that requires examination. In narrow terms, it worked. There was no collapse of the clearing banking system. The property assets were disposed of over several years rather than in a fire sale. Most of the lifeboat support was eventually repaid. The Bank of England's own losses were relatively modest, and the clearing banks absorbed losses they could sustain. Depositors in the supported institutions were largely protected. But the wider picture is less flattering. Property values fell by something in the order of half from their peak. The stock market fell catastrophically. The FT30 lost around 70% of its value between 1972 and the trough at the start of 1975, which remains one of the worst declines in British market history. Slater Walker, one of the emblematic conglomerates of the era, required its own separate support arrangement from the Bank of England in 1975. And the underlying economic conditions, inflation reaching over 20%, the oil shock, industrial disruption, continued and worsened, culminating in the IMF loan of 1976. So the lifeboat prevented a banking collapse inside an economic disaster. It did not prevent the disaster. Which brings us to the reforms, because this is where the lasting consequence lies. The crisis made the supervisory gap impossible to ignore. An entire category of institution had been performing banking functions with no oversight, and when it failed, the state had been obliged to organize a rescue anyway. That is the worst of all arrangements. The institutions had the freedom of being unsupervised and, in practice, the protection of being systemic. The Banking Act 1979 was the direct response. It established, for the first time in British history, a statutory system of banking supervision. Deposit-taking became a licensed activity requiring authorization from the Bank of England. A two-tier structure was created, distinguishing recognized banks from licensed deposit takers, and both were brought under supervision. It also created the first British Deposit Protection Scheme, funded by contributions from the institutions themselves. Read that list and notice what it implies. Before 1979, Britain had no statutory bank licensing and no deposit insurance. The system had run for centuries on the Bank of England's informal authority over a club of institutions that knew each other. The secondary banking crisis is what happened when that club stopped containing everyone who mattered. Now, the mechanism generalized because it recurs, and it is recurring. The pattern is this: a regulated sector is constrained by capital requirements, by lending limits, by supervision. Those constraints impose costs. Activity, therefore, migrates to institutions that perform the same economic function without bearing the same costs, because they fall outside the definition the regulation uses. The migration is not a conspiracy. It is the ordinary consequence of a rule that binds one category of firm and not another performing the same activity. The unregulated sector then grows fastest because it is cheapest, and it is invisible to the authorities precisely because it is defined as being outside their remit. So nobody is measuring it. And when it fails, it turns out to be connected to the regulated sector after all, through lending, through shared collateral, through common depositors. So the authorities intervene anyway. That is the shape of the secondary banking crisis. It is also, in substantial part, the shape of 2008. The institutions at the center of the American crisis were not primarily commercial banks. They were investment banks, structured investment vehicles, conduits, and money market funds, entities performing maturity transformation, borrowing short and lending long, outside the perimeter of banking supervision and without access to the discount window. Northern Rock in Britain was a bank, but its funding model was the same one, a small retail base and heavy reliance on wholesale markets that could and did disappear in days. The specific vehicles change. The structure is identical, bank-like activity, conducted by non-banks, funded short and lent long, invisible to supervision until it is systemic. There is one more element worth drawing out, and it concerns the trigger. The crisis is often described as being caused by the property crash. That is not quite right, and the distinction matters. The property lending was the exposure. The trigger was the withdrawal of wholesale funding, and that withdrawal happened because of a loss of confidence in the sector, not because anyone had calculated that particular property loans were bad. A firm with sound assets and short funding can be destroyed by a funding withdrawal. A firm with poor assets and stable funding can survive for years while it works them out. Which means the vulnerability to watch is not the quality of the assets. It is the stability of the liabilities, how quickly the money funding an institution can leave, and whether anyone is obliged to keep lending when it becomes frightening. That is the question that would have identified every secondary bank in 1972, and it did not require any judgment about property values at all. It is worth spending longer on the individual institutions because the abstractions only mean something when you can see how one of these companies actually operated. London and County Securities is the clearest case, and it is the one that started the run. It had grown very fast. Founded in the 1960s, it expanded through acquisitions into a group doing second mortgage lending, property finance, and general banking-style business. Its chairman, Gerald Kaplan, was a prominent figure, and the board included well-known public names, including, at one point, the leader of the Liberal Party, Jeremy Thorpe. That last detail is worth registering, not as gossip, but as evidence of how respectable these institutions appeared. A company with a party leader on its board is not operating on the fringe of respectable finance. It is at the center of it, at least as the public would perceive it. Its lending included second mortgages at high rates to borrowers who could not obtain finance from a clearing bank, and property loans at the speculative end of the market. Both are profitable while values rise, and both fail together when they do not. When the results published in November 1973 revealed the position, the share price fell by roughly half in a day, and the wholesale market simply stopped. What happened next is the important part, and it is what makes this a systemic event rather than one company's failure. Depositors did not perform a careful analysis of which other secondary banks resembled London and County. They withdrew from the category. That is rational behavior for an individual depositor and catastrophic in aggregate. If you cannot cheaply distinguish a sound institution from an unsound one, and the cost of being wrong is total loss, the correct individual action is to withdraw from all of them and re-examine later. Which means an institution's fate depended not on its own lending decisions, but on whether it was classified in the same bucket as the first one to fail. Several of the supported institutions were, by most accounts, reasonably run. They failed because their funding was of a kind that leaves when frightened, and they were adjacent to something frightening. Cedar Holdings is the other case worth describing because its rescue came before the general lifeboat and shows how the mechanism developed. Cedar was a second mortgage lender that ran into trouble at the end of 1973. Its principal shareholders included substantial institutions, and a rescue was assembled in a single weekend in December. The shareholders and a group of banks putting up support to prevent an immediate collapse. That weekend is generally regarded as the moment the Bank of England recognized the problem was not going to be contained institution by institution. Within days, the general lifeboat was being organized. Now, the mechanics of the lifeboat itself, because the banks provided support, hides a good deal of structure. The support took the form of recycled deposits. The clearing banks placed money with the secondary institutions, replacing the wholesale deposits that had been withdrawn. That is not a capital injection. It does not absorb losses. It is liquidity, provided so that the institution does not have to sell assets immediately. The distinction matters enormously and is frequently muddled. An institution with good assets and no cash needs liquidity, and providing it costs the provider nothing in the end because the loan is repaid. An institution whose assets are worth less than its liabilities needs capital, and providing it means somebody absorbing a loss. The lifeboat was designed as a liquidity operation on the theory that the property assets were fundamentally sound and only unsaleable at that particular moment. For some institutions, that was true. For others, it was not, and the support turned into losses. That ambiguity between illiquid and insolvent is the central difficulty in every rescue of this kind, and it is usually impossible to resolve at the moment the decision has to be made. The distinction only becomes clear later when the assets are eventually sold. Which is why rescues are always criticized. The critics who say the institutions were insolvent and should have been allowed to fail, and the defenders who say they were merely illiquid, are both arguing about a fact that nobody knew at the time. There is a control mechanism worth noting too. The clearing banks providing support insisted on conditions, restrictions on new lending, on dividends, on the disposal of assets, and in some cases installed their own people. Support came with supervision attached, imposed by creditors rather than by a regulator. That is an interesting arrangement, and it is essentially what happens whenever a lender rescues a borrower. It was, in this case, a private substitute for the public supervision that had never existed. Now, the property market itself, in more detail, because the scale of the reversal explains why the assets could not simply be sold. The boom had been extraordinary. Between roughly 1970 and 1973, commercial property values in Britain rose sharply, driven by a combination of easy credit, inflation expectations, and a genuine shortage of modern office space in London. Development finance in that market followed a standard pattern. A developer would borrow to acquire a site, borrow more to build, and repay by either selling the completed building or refinancing it against its rental income. The whole structure depended on the building being lettable and on refinancing being available at the end. When rates rose to 13% and the economy contracted, both assumptions failed at once. Tenants did not appear, refinancing was unavailable. And the value of the completed building, the number the whole loan had been sized against, fell substantially. Some buildings completed in that period stood empty for years. Centre Point in London had already become a public symbol of speculative development, standing vacant, and the politics of empty office blocks during a housing shortage were poisonous. So, the collateral behind the secondary bank's lending was not merely worth less. In many cases, it was genuinely unsaleable at any price the lender could accept, which is precisely the condition under which an orderly disposal over years is the only alternative to writing it off entirely. That is what the lifeboat bought: time, not a solution, time in which to sell things gradually into a market that would eventually recover. It is worth being clear about who ultimately paid, because it was not nobody. The shareholders of the secondary banks were largely wiped out. That is the correct outcome, and it happened. The clearing banks absorbed losses on the support they provided, which fell on their own shareholders and, indirectly, on their customers through pricing. The Bank of England took some losses on its 10% share. Depositors were largely protected, which was the point. And the broader public paid through the economic conditions the crisis contributed to, though disentangling the banking crisis from the oil shock, inflation, and industrial disruption of the same years is genuinely difficult, and anyone claiming a precise figure is guessing. What can be said is that the loss was distributed among parties who had some connection to the risk, rather than falling on depositors who had none. That is a defensible outcome, and it is not automatic. It was the result of a decision. There is a further comparison worth making with the same country 34 years later. Northern Rock in 2007 had a funding model that would have been instantly recognizable to anyone who lived through 1973. A modest retail deposit base and heavy reliance on wholesale markets and securitization to fund long-dated mortgage lending. When the wholesale market closed in August 2007, the mechanism was identical, not a judgment about Northern Rock's mortgage book, which was of reasonable quality. A withdrawal of short funding from an institution that could not survive without it. The differences are instructive. Northern Rock was a bank, fully supervised, with deposit insurance in place, all the things that did not exist in 1973. And it still failed, because the deposit insurance at the time was partial and co-insured, which gave depositors a rational reason to queue. So, the lesson of 1973 had been learned in one respect and not in another. The perimeter had been fixed. The funding vulnerability had not. There is a final observation about why this episode has vanished from memory. Partly, it is the secrecy. An event conducted deliberately, without publicity, leaves fewer traces. There is no footage of a queue, no famous photograph, no single dramatic day. Partly, it is the company it keeps. 1973 to 1976 in Britain contains the oil shock, the three-day week, the miners' strikes, 20% inflation, 2 general elections, and the IMF loan. A banking rescue conducted in private meetings does not compete with that for attention. And partly it is that it worked. Prevented disasters generate no anniversaries. The counterfactual, a cascade of failures through the clearing banks in 1974, did not happen, so there is nothing to commemorate. Which is a general difficulty with successful crisis management, and one worth stating plainly: it produces no evidence of its own necessity. The people who organized the lifeboat were criticized at the time for rescuing the reckless, and the only defense available to them was a description of something that had not occurred. That is a hard argument to win, and it is the reason interventions of this kind are usually late. The last thing worth saying is about what the episode reveals regarding definitions. Everything that went wrong followed from a legal boundary that did not match an economic one. Institutions doing banking were not classified as banks because the classification was drawn by reference to a Companies Act provision rather than to what the institutions actually did. The fix in 1979 was to redraw the boundary around the activity, deposit taking, rather than around a category of company. That is the right principle, and it is a principle that has to be reapplied continuously because financial innovation consists very largely of finding new containers for old activities. A money market fund is a bank that is not called one. A stablecoin issuer takes deposits and invests them and is not called a bank either. The question that identified the secondary banks in 1973 is the same one that identifies their successors now, and it is not a technical question at all. Does this institution take money from people who expect to get it back on demand and lend it out for longer than that? If so, it is a bank, whatever the statute says, and it will eventually need somebody to stand behind it, whether or not anybody has agreed to. There is one more question this raises, which is why the reform took 6 years. The crisis was acute in December 1973. The Banking Act did not reach the statute book until 1979. That is a long gap for a problem everyone involved understood immediately, and the reasons are worth examining because they recur. The first is that the immediate emergency was handled. Once the lifeboat was in place and the runs had stopped, the pressure to legislate fell away. Crisis reform is driven by fear, and fear is a depreciating asset. The second is that Britain in those years had other things occupying it. 2 general elections in 1974, the oil shock, inflation running above 20%, the IMF negotiation in 1976. Banking supervision legislation is technical, uncontroversial in principle, and therefore easy to postpone in favor of anything with a deadline. The third is that the Bank of England was genuinely ambivalent. Its supervisory tradition was informal, personal, and discretionary, and it valued that. A statutory licensing regime meant rules, appeals, published criteria, and a loss of the flexibility that the eyebrows had provided. There were people at the bank who regarded formal supervision as a downgrade rather than an improvement. And the fourth is that a European Community Directive on credit institutions was in preparation, and there was an argument for waiting to see what it required rather than legislating twice. None of those reasons is disgraceful. Together they produced a 6-year delay in closing a gap that had just cost over £1 billion to paper over. That pattern, acute crisis, emergency response, delayed reform, fading urgency, is close to universal. The useful observation is that the reform window closes fast, and the quality of what gets legislated depends heavily on how much was prepared before the crisis rather than after it. There is also something worth saying about the people who were right in advance. Concerns about the secondary sector had been raised before 1973. The rapid growth in lending after competition and credit control was visible in the monetary statistics, and there were commentators pointing out that a great deal of it was going into property and being funded by short money. The difficulty was that being right early is indistinguishable from being wrong. Anyone who warned in 1972 that the secondary banks were dangerous spent a year watching them post excellent results. That is the structural problem with this class of warning. The vulnerability is in the funding structure, which produces no symptoms at all while confidence holds. There is no gradual deterioration to point at, no rising default rate, nothing that shows up in the results. The institution looks entirely healthy right up until the moment its funding leaves, and then it is finished within weeks. Which means the evidence supporting a warning never improves until it is too late to act on. That is an uncomfortable thing to build a supervisory system around, and it is the reason modern regulation focuses on liquidity coverage and funding stability rather than waiting for asset quality to deteriorate. Those rules exist because of episodes like this one. Institutions that were solvent on paper and destroyed by the maturity of their liabilities. One further point about what the clearing banks got out of it. It is tempting to read the lifeboat as public-spirited, and there was an element of that. But the clearers had substantial commercial reasons to participate, and it is worth being honest about them. They were creditors of the secondary banks. They held property lending of their own that would be marked down if a fire sale occurred. Several of them had equity stakes in the institutions being supported, and they operated in a system where the governor's request was not, in practical terms, refusable. So, the lifeboat was not charity. It was a group of creditors acting together to protect their own collateral, coordinated by a central bank, with the authority to convene them and the standing to make participation expected. That is a more durable basis for a rescue than goodwill, and it is why the arrangement held. Everybody in the room had money at stake, which is worth remembering when this kind of coordination is proposed today. It works when the participants are exposed. It does not work when they are not, and no amount of moral pressure substitutes for that. There is a last thread worth pulling about the phrase that gave the sector its name. Secondary bank was not what these institutions called themselves. They called themselves banks. The qualifier was applied afterwards by the authorities and the press once the category needed a name in order to be discussed. That is a small thing, and it is genuinely revealing. A sector that has no name cannot be measured because there is no line in any statistical return corresponding to it. The Bank of England collected data on the institutions it supervised. Nobody was aggregating the balance sheets of the ones it did not, because they were not a category. They were simply a set of companies that happened to be doing similar things. So the answer to how big is the secondary banking sector in 1972 was not a large number. It was that the question could not be asked because the sector did not exist as an object of measurement. Naming a thing is the precondition for counting it, and counting it is the precondition for noticing it has become dangerous. That sequence. Activity migrates outside the perimeter. The migrated activity has no name. Having no name, it has no statistics. Having no statistics, it is invisible until it fails. Is the most durable part of this whole story, and it is the part that is repeated most exactly. Shadow banking is a term from 2007. The activity it describes had been growing for a decade before anybody named it, and the naming is what made it possible to estimate its size, which turned out to be far larger than the people responsible for financial stability had assumed. The parallel is close enough to be uncomfortable. In both cases, the activity was legal, visible in principle, conducted by identifiable companies filing accounts, and collectively invisible because nobody had defined the aggregate. which suggests a practical test that does not require any forecasting skill at all. Ask what proportion of credit in an economy is being extended by institutions that do not appear in the banking statistics. If the answer is not readily available, that is itself the finding. In 1972, nobody could have answered it for Britain. In 2006, nobody could answer it for the United States. Those are not coincidences. They are the same condition, and it is a condition that can be detected without predicting anything. And that, in the end, is what makes this episode worth an hour rather than a footnote. It is not a story about property, or about the 1970s, or about a group of aggressive lenders who overreached. Those are the surface. It is a story about a definitional boundary that stopped matching economic reality, went unnoticed for years because nothing was measuring the gap, and then cost over £1 billion and 6 years of legislation to close. The boundary has been redrawn since, several times. It will need redrawing again, because financial activity moves and definitions do not move by themselves. The only real defense is somebody whose job it is to keep asking where the banking is happening now, rather than asking whether the banks are behaving. One closing detail, which has stayed with me more than any of the numbers. The meeting on the 19th of December 1973 lasted a matter of hours. The governor set out the position, the clearing bank chairman agreed to participate, and the arrangement that prevented a systemic collapse was settled between a small number of men in one room on the same day the country was told it would be working 3 days a week. There was no legislation behind it. No statutory power compelled anybody to attend or to contribute. It rested entirely on the authority of an institution and the expectation that a request from it would be honored. That is either reassuring or alarming depending on your temperament, and it is worth holding both readings at once. It was fast, it worked, and it could not be replicated today. Because the informality that made it possible is the same informality that had allowed the gap to open in the first place.